Continuing from our earlier research, where we thoroughly analyzed each sector's Q2 performance to find out whether Nifty can finally breach 26,000 this quarter or not, we are now shifting gears to uncover smarter investment opportunities for you. In case you missed that video, you can find the link in the description below. Let's take this journey step by step to deliver a clear, actionable perspective tailored for your next investment move. And don't forget to like, comment, and subscribe to keep this conversation going. Yeah? But first, let's tackle the elephant in the room, the wild FOMO around gold and silver. Gold is up 25 to 30% this year, almost at $4,100 an ounce, while silver has surged 55%, fueled by inflation fears, geopolitical tensions, and central bank buys. It's tempting, sure, but chasing that glitter often ends in a crash. FOMO investments have a high failure rate, like buying at the top only to see the bubble pop. History backs this. In 2011, silver plunged 70% and gold dropped 45% after peak rallies, driven by overvaluation and rising rates. Even now, with gold at records and silver riding industrial demand, experts caution against jumping in. A stronger USD or a rate hike could trigger correction. Get ready to explore our top 5 sectors and related ETFs expected to shine in recent years and offer a stable alternative to gold and silver rush. Top 5 sectors are retail and FMCG, a steady force in India's consumption story thriving on domestic demand. Pharmaceuticals, a global health leader poised for growth with innovative potential. Automobiles, gaining momentum with EV trends and strong domestic sales. Steel, the backbone of infrastructure driving robust growth. IT, harnessing AI to lead with transformative opportunities. But first, let's do some boring things like number crunching. Trust me, these stats will light up your portfolio strategy like nothing else. Let's talk about retail and FMCG. The silver bullet is its rock solid domestic focus. Looking back, FMCG delivered a 5-year CAGR of 9% and 10-year CAGR of 16%, thanks to reliable demand and brand strength. During tough times, it maintained the gains of 5 to 10%, proving its resilience. Looking ahead, we expect 5 to 8% growth for FY26, fueled by rural recovery and e-commerce boom. Compared to gold and silver, it lagged with a 9% 5-year return against their 26 and 33%. But that lower risk makes it a safer bet. For investing, check out the ICICI Pru Nifty FMCG ETF. It's packed with ITC at 25%, HUL at 30%, and Nestle at 15%. With a lower expense ratio of 0.2%, it clocked a 5-year return of 12%. And in future, it's expected to hit 8 to 10% returns annually. Next up, let's dive into pharmaceuticals. Dominance in generic drugs makes it a global health powerhouse with steady demand for chronic treatments. Historically, it offered 5-year CAGR of around 6% and 10-year CAGR close to 13%, riding on export growth and R&D. During volatile periods, it stood out with gains of 15 to 20%, showing solid stability. Looking forward, we project 7 to 9% growth for FY26, boosted by AI in research and development. Against gold and silver, it trailed with a 6% 5-year return, but it shines in health-driven volatility like 2020 COVID crisis. For investing in pharma, consider the Nippon Nifty Pharma ETF. It features Sun Pharma at 25%, Dr. Reddy's at 10%, and DV's at 9%. With an expense ratio of 0.21%, it delivered a 5-year return of about 19%. Jumped 15 to 20% in 2020's volatility and aims for 7 to 9% growth going forward. Let's now discuss automobiles. The silver bullet is its EV transition and India's manufacturing might. So much that now China is complaining as well. Looking back, it posted a 5-year CAGR of about 10% and 10-year CAGR of around 12%, riding auto boom cycles. During volatility, it shows quick recovery. We are forecasting 6 to 8% growth for FY26, powered by AI in EVs, though tariffs are a concern. Compared to gold and silver, it lagged with a 10% 5-year CAGR, but it outpaces in recovery phases. For investing, check out the UTI Nifty Auto ETF. It's loaded with Maruti at 25%, Tata Motors at 20%, and M&M at 15%. With a low expense ratio of 0.2, it achieved a 5-year return of about 18% and targets 6 to 8% returns in the future. Let's forge ahead with steel. With its role as the infrastructure backbone fueled by government capex and urban growth, steel is a formidable sector. Historically, it delivered a 5-year CAGR of about 8% and 10-year CAGR of around 9%, tied to industrial demand. We project 9 to 12% growth for FY26 from capacity expansion to 300 metric tons. Against gold and silver, it trailed with an 8% 5-year return, but it's linked to industrial rebounds. For investment, consider the Nippon Nifty Metal ETF. It includes Tata Steel at 20%, JSW at 18%, and Hindalco at 15%. With an expense ratio of 0.4%, it posted a 5-year return of about 8% annually and aims for 9 to 12% growth yearly ahead. Finally, let's tap into IT. The silver bullet is its AI and digital transformation expertise, positioning India as a tech hub. Looking back, IT achieved a 5-year CAGR of about 11% and 10-year CAGR of around 13%, thanks to outsourcing and cloud growth. During volatility, it rebounded with a 15% gain in upcycles. While we see flat FY26 based on AI adoption, though job displacement is also a risk. Compared to gold and silver, it lagged with an 11% 5-year return, but it shines in tech recoveries. For investing, check out the Nippon Nifty IT ETF. It's packed with Infosys at 25%, TCS at 20%, and HCL at 15%. With an expense ratio of 0.22, it delivered a 5-year return of 12%. And it has bounced back 15% during recoveries. For you, sharp investors, this means strategically allocating to domestic powerhouses like FMCG and autos for stability, while cautiously monitoring export-sensitive sectors like IT to ensure you're well-positioned to ride the wave ahead. Tying it back, with Q2 resilience surpassing forecasts, cushioning us from FII outflows and global shocks, we are inching towards a greater market dependence. 2 to 3% uplift could propel Nifty past 26,000 by late October. Keep an eye on risks like weak banks or rising CPI, but with these ETF picks, you're set to navigate this rally with confidence. Thank you for joining me today and investing your time in this conversation. It truly means a lot.